Real Estate Credit Investments is a specialist investor in UK and European real estate credit markets with a focus on fundamental credit and value. Now, recently Hardman & Co published a report on the company entitled Positioned for the Current Crisis. Joining me today to discuss the report is Hardman & Co analyst Mark Thomas. Mark, good morning to you.
Good morning, Giles.
Mark, first off, your report on RECI, it sits behind a disclaimer. Why is that?
It's a very standard disclaimer that many investment companies have. In essence, for regulatory reasons, there's some countries, like the US, where the report should not be read. It's not a simple asset class, and the report should really only be looked at by professional and qualified investors. But it's a very standard disclaimer, absolutely nothing to worry about.
Sure. Okay. Now, your recent report, it was called Positioned for the Current Crisis. What can you tell us about the report, Mark?
Yeah, in this note, what we did was we reviewed how RECI is positioned to face the current market challenges. And what we did was we noted the track record of superior credit assessment, monitoring and collection, reducing the probability of default. We looked at the high quality and the high level of security, which limits the loss in the event of default. We looked at the low exposure to high-risk sectors and the proven limited loss in ones where they have had exposures in the past. We looked at its proven conservative accounting. We looked at the benefits to income from rising rates and from reinvestment opportunities. Now, of course, there are risks, and these include investor sentiment as well as the macroeconomic environment. But the Cheney team have proved through COVID-19 that it has the skills and the expertise to deliver consistent returns in challenging times.
Sure. Okay. Just looking at your first point then, could you tell us a bit more about the track record of superior credit assessment, monitoring and collecting, reducing the probability of default?
Yeah, I mean, the single most important issue for positioning RECI in the current crisis is not to look at what they've done in the past few months or even the past year, but really to look at its fundamental approach and really dig into the business model. And to do that, you've got to look at the fundamental credit control process. Now, we've explored this in a number of our notes, and actually fundamentally pages 14 to 19 of our initiation report. In summary, what RECI has is a structured and a considered approach to lending. The manager's, Cheney's culture is hugely important to this, and we take considerable comfort in its fundamental risk and reward approach. The good credit performance reflects the benefits of being a secured lender, which reduces the probability of default and the loss in the event of default. The portfolio is increasingly diversified by counterparty, jurisdiction, sector, type of borrower. This and our other notes go into a lot more detail covering areas such as new lending, diversification, interest rate exposure, security cover, borrowers and leverage. But the single most important thing is the culture. The lenders own the borrowing. It's a very conservative culture.
Of course. And the secured nature of the portfolio?
Yeah, I mean, the book has been migrating to the senior loan book, which now represents 87% of gross assets, and the pipeline of new loans is entirely senior. All the top 10 exposures are now senior loans. The portfolio section of our note goes into detail, but highlights that the average loan to value is just 60.4%, which gives you a great deal of security cover. What we also go into is the importance of the execution, having good execution of security, and the high quality of the security, which is in prime locations, and that's really important too.
Indeed. And you said there was low exposure to high-risk sectors and proven limited loss in the ones where they've had exposure in the past.
Yeah, I mean, if you look at some of the high-risk exposures, there's minimal exposure to shopping centres, so that's under 2% of gross assets. In secondary offices, so poor locations, which is nil. In logistics, it was just 3% of gross assets. Where RECI has exposures to offices, as I mentioned, it's in prime locations with high quality tenants, where both and capital values typically are more sustainable than you'd see in non-prime locations. Financing for land development is just 4% of the portfolio. So RECI is not about financing speculative development where there's much more risk. The bottom line is that if you look at through the COVID-19 pandemic, RECI did not suffer capital losses on, say, its exposure to a super high-risk sector like hotels, where it managed those exposures, restructuring debts where required, with additional capital being provided by its borrowers. So we can look at both the high-risk sector and what it's done in the past in those sectors.
Okay. And what can you tell us about the accounting points and benefit to rising rates?
Yeah, you can see from the COVID-19 experience that RECI takes mark-to-market hits up front on its bond portfolios and then releases them in later periods. So that's why I was saying it's conservative in the accounting. In terms of the rising rates, the loan book average duration is just 1.6 years, and the pipeline, which is equivalent to two-thirds of the stock, is 100% floating rate. The portfolio yield has risen by a tenth in just the past couple of months.
Sounds good. Finally then, what can you tell us about the risks?
Yeah, I mean, the risks of a recession are very clear to see. You get higher interest rates, low disposable incomes, falling property prices, both residential and commercial. Yeah, and that's compounded by distressed sellers of assets. You've obviously got rising social tensions at the minute, governments facing large fiscal deficits, central bank inflationary pressures. There are lots of risks out there. But what I'd fundamentally say is look at what happened through COVID-19 and look at how well RECI managed through that. Yeah, you did not see losses. This is a very resilient portfolio that continued to pay the dividend all the way through that. And that's the key message to take from this.
Brilliant. Okay. Talking to us today was Mark Thomas, analyst at Hardman & Co. Mark, thanks for joining Directors Talk today.
Brilliant.